Hello, welcome back to Commerce Easy Notes. Today we are going to deal with second part of inflation where the price level changes methods are discussed with examples. Here we are going to discuss on CPPA, the first method in price level changes with regard to inflation. We have discussed in the previous videos what is CPPA, that is current purchasing power accounting. What is it? What are the features? Here we'll be discussing about the steps involved along with the problem. The first step in preparing CPP accounting is prepare the financial statements as per historical cost. That is, profit and loss account and balance sheet is prepared in the traditional method. The second step involved is monetary items and non-monetary items identification. We are classifying the items into two. That is, monetary items and non-monetary items. Monetary items are those assets or liabilities carrying the value in dollar which will not change in future. These items have fixed numerical value. So even the purchasing power of the dollar changes, it cannot change. Item cost $25,000 in cash and have a fixed value although in inflation. The other microeconomic factors might affect the purchasing power. The other factors may consider the purchasing power. Non-monetary items are those items which cannot be quickly changed into cash, such as fixed assets like property, equipment. Such cannot be easily changed into assets. That is liquidity, on the concept of liquidity. Therefore, these items are known as non-monetary items. We are classifying the items into two, monetary and non-monetary. The third step, these have to be, the monetary items should be stated in the same figures. Monetary items are to be stated in the same figure shown in the statement, representing the current values, whereas non-monetary should be converted into the current price. And the fourth step involved prepare balance sheet and profit and loss account. It also involved a formula for converting these non-monetary items, that is known as conversion factor. Index you are converting to divided by index you are converting from. That is the formula for converting the non-monetary items. Now we will see this conversion through an example. A machinery was purchased in 2010 at a cost of rupees 2 lakh. The wholesale price level index rose from 100 in 2010 to 200 in 2019. The machine was sold in 2019. What will be the value of machine in 2019 considering the price level change? Therefore, according to the formula, conversion factor is equal to index you are converting to divided by index you are converting from. Index you're converting to is 200. We are converting to 2019. Therefore, 200 is the index. From 2010, that is 100. 200 divided by 100. Therefore, the amount to 2 lakh into 200 divided by 100. Rupees 4 lakh. This is how we find out the purchasing price by calculating the price level index. The income statement for the year ended 31st December 2019 of Crystal Limited and a balance sheet as on that date is given below. You are asked to prepare the final accounts after adjusting price level changes under CPPA method. The question is given, income statement is given, sales rupees 3 lakh, cost of goods sold is given, opening stock which is following FIFO method, that is 60,000, purchases 1,20,000, cost of goods available for sales becomes 1,80,000. After subtracting closing inventory 20,000, the cost of goods sold is 1,60,000. Now the operating income is how much? Sales minus cost of goods sold. 3 lakh minus 1 lakh 60 gives you 1 lakh 40,000. That is operating income 1 lakh 40,000. Now subtracting the operating expenses 40,000, depreciation on machinery 20,000, and interest on loan is 10,000. All those operating expenses total gives you 70,000 minus 1 lakh 40,000 minus 70,000 gives you 70,000 as retained earnings. Now given is the balance sheet. Particulars are given: equity and liabilities, share capital 2 lakh, reserve and surplus, non-current items are given, long-term borrowing with the note number 1 50,000 and the current liabilities with note number 2 70,000. The total amounts to 3 lakh 20,000. And the second part, the assets part, that is non-current asset, fixed asset, tangible with note number 3 2 lakh. Current assets include inventories 60,000, trade receivable with note number 4 36,000, cash and cash equivalents 24,000. The total amounts to 3,20,000 as liabilities. 3,20,000 is the total of assets also. Notes are given in the questions. Notes are given. We have given note number 1 as long-term borrowing, bank loan considering of 50,000, and current liabilities consider of creditors with 70,000. Tangible assets have machinery 2 lakh. Trade receivable have sundry debtors with 36,000. Debtors and creditors balance remain unchanged throughout the year, with general price indexes are given below. That is the opening 1/1, that is 1st January 2019 with the price level index 200. The average for the year index becomes 240, and on 31st December 2019 it becomes 300. So these are the price indexes. So considering these average is considered 240. That is considering, like for example, you say purchases. Purchases can be conducted at any time. Now we cannot say it will be on the opening of the month, or it cannot be on the second month only. It can be done throughout. So these purchases can be done throughout. Similarly, sales. So such items should be stated with average index. So this is what the question is. Now moving up to the answer part. Solution part. Profit and loss statement for the year ending 31st December 2019 under CPP method, following FIFO method. 4 columns: particulars, historical cost, conversion factor, and restated figure. Firstly, like as given in the question, the profit statement, sales is taken. Sales is rupees 3 lakh. So as we have told before, sales is happening throughout. Therefore, the average index is taken here. The conversion to by conversion from. Therefore, 300 is the conversion factor in first general price index. Therefore, the numerator always become 300. For sales, we take average, therefore divided by 240. 3 lakh into 300 divided by 240 is equal to 3,75,000. Now opening inventory under FIFO method, 1,50,000. Now adding opening inventory and purchases gives out 1,80,000, 60,000 plus 1,20,000, and restated figure 2,40,000, 90,000 plus 1,50,000. Now lessing the closing inventory 20,000. Closing inventory statements average price 300 divided by 240, 25,000. In certain cases, we also consider closing inventory as the closing index value, that is 300 by 300. That is how in certain situations we deal. Here in this question we are dealing with it only with average value, and cost of sales is calculated by subtracting closing inventory. Operating income is equal to 1 minus 2, that is sales minus cost of sales. 3 lakh minus 1 lakh 60, 1 lakh 40,000. And in restated figure, 3 lakh 75,000 minus 2 lakh 15,000, 1 lakh 60,000. Now, less operating expenses, 40,000. Okay, taken in average index, 300 divided by 240, 50,000. Depreciation, 20,000. Depreciation is taken in the opening index, therefore 200. That is 30,000. Interest on bank loan. Bank loan is usually paid at the end of the year. Therefore, it is taken at the closing index. Therefore, 300 divided by 300 gives out the same result, 10,000. So this is what in operating income. The total operating income becomes 70,000 and in restated figure 90,000. So net profit is equal to operating income minus the expenses. That is, net profit is equal to operating profit minus the expenses. That is 1,40,000 minus 70,000, 70,000. And in restated figure, 1,60,000 minus 90,000, 70,000. This is how we obtain the net profit. Gross profit minus the expenses. Now, monetary expenses as per the statement given, that is from the statement given below, we have to restate out this 5,000 here. After subtracting this monetary asset from the net profit, we obtain the retained earnings as 65,000. So we'll see what is the next statement. Before that, we have to accompany with certain notes for preparing the balance sheet. With balance sheet, we have to prepare some certain notes. So, at the beginning, we have discussed certain steps in preparing this CPPA method. And that we set the monetary and non-monetary items. So, monetary items are as such written. We are not restating it in the statement. Therefore, share capital 2 lakh. This should be stated at 2 lakh only. We will see how it is because it is a monetary value. Now, quickly convert it into cash. 300. It is valued at the directly affected. Therefore, 300 divided by 300 only. Therefore, 2 lakh. It is remaining 2 lakh. Now, long-term borrowings. Bank loan is 50,000 into 300 divided by 300, 50,000. Current liabilities, creditors 70,000 into 300 divided by 300, 70,000. And tangible asset, machinery. Machinery, we have purchased it with 2 lakh with the value opening only. Therefore, 300 divided by 200. 3 lakh is the value of machinery. Subtracting the depreciation, 20,000 into 300 divided by 240. We know depreciation is throughout this. Therefore, average should be taken. 30,000 gives 2,70,000. Inventories. Inventories is also throughout. Therefore, 20,000 into 300 divided by 240, 25,000. Trade receivable, sundry debtors, 36,000 into 300 by 300, 36,000. So, now the last part becomes cash and cash equivalents. Increase in cash. The sales proceeds from selling out it is 3 lakh. The amount paid to the creditors in the previous statement, we have obtained 1,20,000. The operating expenses paid is 40,000. Therefore, creditors and operating expenses paid together form 1,60,000. So, therefore, 3 lakh minus 1,60,000 gives 1,40,000. Opening cash balance is given in the question 24,000. Now add increase in cash 1,40,000 from the previous statement. It becomes 1,64,000. When subtracting interest on bank loan amounts to 10,000 and cash in hand becomes 1,54,000. That is what cash in hand in the current situation. Moving Moving on to the computation of monetary gain or loss, we have 5 columns: particulars, historical cost, conversion factor, price level adjusted amount, and purchasing power, it is gain or loss. This statement should be by heart and understood properly. The conversion of monetary asset, given as heading, the net monetary asset at the beginning of the year. Cash is given historical cost 24,000. The conversion factor cash at the beginning, therefore 300 divided by 200, 36,000. Was 36,000, 300 divided by 200. Debtors, the point that should be noted, it is given in the question if debtors and creditors remain unchanged throughout. Therefore, it is taken for the opening balance. Therefore, 36,000 into 300 divided by 200, 54,000. And creditors, and given in the big question that it remain unchanged. Therefore, the index will be the opening. Therefore, 36,000 into 300 divided by 200, 54,000. An increase in case, that is from the previous note prepared, it amounts to 1,40,000. That 300 divided by 240. 240 is throughout it happening. Sales proceeds are happening throughout. Therefore, they should be taken. It amounts 1,75,000. The net monetary asset as on 31 March 2019 amounts to, totaling all this, it becomes 2 lakh. Totaling on the price level adjusted amount, amounts to 2,65,000. Next part is purchasing power loss, that is 2,65,000 minus the sales value 65,000. Net monetary liability at the beginning of the year, bank loan is given 50,000, that is at the opening. Therefore, opening index is valued. It becomes 75,000 and creditors 70,000. We have said creditors and debtors are remaining unchanged. Therefore, opening is taken. 1,05,000. The monetary liabilities as on 31 March 2019 amounts to, totaling of this, 1,20,000 and 1,80,000. Less the purchasing power amounts to 60,000, that is 1,80,000 minus 1,20,000, that is the liabilities alone purchasing power amounts to 60,000. Now subtracting the both assets and liabilities monetary value, the loss of monetary assets amounts to 5,000. This 5,000 is taken considered in profit and loss the end for calculating the retained earnings from net profit. Balance sheet as on 31st March 2019 from the notes we have prepared in the working. Equity and liability, shareholders fund, share capital from note 1, 3 lakh, reserves and surplus, retained earnings 65,000, that is from the income statement. Non-current liabilities, long-term borrowing, that is note number 2, 50,000. Current liabilities, note number 3, 70,000. Total amounts to 4,85,000. The next part, non-current assets, fixed asset, nothing. Tangible asset from note number 4, 2,70,000. Current asset inventories, note number 5, 25,000. Trade receivable, note number 6, 36,000. Cash and cash equivalent, note number 7, 1,54,000. Which also amounts to 4,85,000. Tallying both liabilities and assets. Thanks for watching.